Thank you very much, everybody, for joining. Very much appreciate you taking time out of your busy days to come and listen to us. My name is Richard Bradstock. I'm the Managing Director of the RPA Group, and we are joined today, if I can just get the slideshow going. We are joined today by Donna, Karen, and Emma from IPFG, International Property Finance Group. Now, you will have obviously have read all this on the invite, so none of that is going to be a shock. But the whole point, I think, just to set the scene a little bit in terms of what we are going to talk about today. I think it's fair to say anybody that's interested in property, anybody that's been reading the papers, been listening to government figures and the Bank of England and all these I suppose important players in the market talk about it. I think you'd be forgiven for thinking that suddenly mortgages are impossible, because as ever with the UK press, they are. The headline says one thing and you read the article and it often says something completely different. And so what we wanted to do today is talk a little bit about the possibilities around mortgages and the rates and options available for an investor into UK property or a buyer into UK property. And then to also talk a little bit more about the wider property market and try and answer the question is, on a very basic level, is it a sensible thing to do, buying UK property? So that really is what we're going to talk about. Just to introduce IPFG a little bit further. So IPFG and Donna and her team are our preferred mortgage brokers, and we've been working. Donna and I have worked together for a decade, if not give or take now, haven't we?
Thank you for my our age, Richard.
I like that you included Donna, not me.
Yeah. So, and when you buy a property, it's such an important thing, the mortgage. It's such an important aspect of it. And we're always delighted to be working with Donna and her team because in the end, we need a safe pair of hands for our investors and our buyers. And this is what Donna and her team provide. So we're going to talk a little bit more about that in a minute, and Donna will and the guys will expand on those services. But I think as a first point of call, where we should probably start is the very simple question, and Karen, I'll come to you on this. Is it still possible to get lending? So perhaps you could, on a very basic level, answer that question.
Absolutely, Richard. So we here at International Property Finance Group, we specialise in mortgages for expats and foreign nationals. We do your normal UK resident ones as well, but expats and foreign nationals are our bread and butter. So as you can imagine, over the last couple of months with everything that's been going on, I am just constantly getting questions about whether or not expat and foreign national mortgages are still available. And I can quite confidently say, yes, they are. Yes, there's still lenders, there's still products, and there's never actually been a point where there hasn't been mortgages available. Obviously, it's been no secret that there's been lots of movement in the market in the last year, probably mostly. But regardless of all that, and regardless of what people might have heard in the media, expats can get mortgages. There's still plenty of lenders out there that do them. Talking of lenders, we work with a huge range of them. We work with probably over about 200 lenders now, I'd say, ranging from your normal UK high street lenders all the way to the kind of quirky lenders, the ones who really think outside the box and the ones who don't do mortgages on a tick box exercise. So they all offer different products. So our job is to kind of put all the puzzle pieces together, all of the clients' kind of different situations. We have some self-employed, some employed, some work in all of these weird and wonderful companies. And we put all of the criteria together and find lenders that can help.
Can I just jump in there for a second, Karen? Just to ask a sort of further question. So again, I think obviously one of the reasons why people would have thought that there was potentially a problem around lending in the, in the last 3-4 weeks. I mean, it really has been a very short-term thing. These headlines about, thousands of products being pulled from the market. Can you just tell us a little bit about that? And, I suppose the truth behind that, if you see what I mean, and have they come back to market, I guess, is the follow-up.
Absolutely. So like you said, the media said that look, thousands of products has been pulled from the market. And to be honest, yes, they did. But then they came straight back again. And what we found is obviously because the Bank of England base rate was increasing, the lenders had to kind of rethink how they were doing their products and how they were going to price them and what they were going to offer. So what we did find is, yes, they took them away, but they were bringing them back again a couple of days later. And it wasn't the point that they were taking the products away and stopping lending entirely. It was a case that they were just changing it around, just so they were kind of moving with the times. Yeah. So the scaremongering, if I can use that word, the scaremongering of the media was making it seem like there weren't any products. But even though there were lots of products that were pulled, there were still thousands on the market. So it seemed to be
a repricing exercise more than anything.
Yeah, absolutely. It wasn't a case they were taking it away completely. It was just merely a repricing exercise, really.
And I think on that,
if you don't mind, if I could jump in,
of course, please, Donna.
Richard, you and I have seen this on many, many occasions when we go through major changes in the lending market. And what normally happens, there's a lot of there's a lot of noise, and then the rates are pulled, and quite rightly so. Lenders were worrying about their margins and what that was going to have an effect on their bottom line. At the end of the day, they pulled those products, and for us here at International Property Finance Group, the most important thing was making sure that the applications that we had, that we were getting those over so those clients could benefit those interest rates. So getting those applications in. We managed to get most of our products through. Unfortunately, there were some scenarios where we were told like this is with an immediate effect, and we couldn't control that. But then what happens is they then come out with a repricing, and this is how I've seen this probably 4 times in my 20 odd years of doing finance. And they come out with a repricing, and they realise they're not getting any business, and then their margins will be squeezed slightly. And over since the 10th of October to now, if you look at the SONIA rate and what the banks buy their money at, that's reduced by that. Those rates have actually reduced by over 1% if you take it from a 2-year fixed rate to a 7-year fixed. So there's been a lot of change in the amount that the banks were borrowing at, and they had to look at their risk factor there. That was a major part of why they pulled those products. And it did cause a lot of disruption, especially to the mortgage consultants, and it's not nice. We don't like to deliver that news to the client. What's most important, we stood side by side with the client and going, look, we'll do whatever we can to get that across the line. But in many instances, what we found there was very little notice period. In some instances it was immediate, and in some instances you've got 24 hours. So we were working, I know my team were doing 15, 16-hour days just to make sure that we were keying on these applications, to make sure that those clients that did have applications, they get there in time. But I mean,
well, I think that's why we like to refer you guys, because of the efforts you make. But I think with Emma, if I can come to you now on the next slide, if I can manage to move it on. No, gone too far. Donna's obviously mentioned there that, what we're starting to see is banks shaving margins, and, the sort of knee-jerk reaction to the raise of interest rates and so on that we saw over the last few weeks. There is an element of sort of returning to normality here. So where are we at the moment with rates? I think it's a pretty simple question.
Absolutely. So at the moment, we're noticing they range from about 3.5%, as displayed there. Over the last few weeks, consistently every day, I'm getting emails from lenders just shaving incrementally little bits off their rates. It's all reductions at the moment, which is good news. But I've kind of listed the different rate types in order of how expensive they are at the moment or how cost effective. Discounted from the lender's standard variable seems to be the cheapest type of deal at the moment, followed by tracker. I know there was lots of noise about the Bank of England base rate reaching 6% next year, but obviously that's kind of been reduced. I was reading about 4% now. Next spring maybe will be the maximum, which is great news. So trackers are still very competitive. Fixed rates seem to be the most expensive at the moment, but again, down with the swap rates slowly reducing over time. They seem to be reducing too. So lots of competition.
There's been. It's. I mean, obviously, you guys are sort of at the coalface, as it were, dealing with this on a sort of day in, day out basis. But there have been some. I saw some of the really big players in the market, like HSBC, have obviously. There was I think they came off 0.4% or something last week. There was an article about that, and so I mean, and again. I know this might be a good time to just sort of give a little bit of your history in terms of why you became a mortgage broker, because actually, what I think people have to realise, or what everyone has to realise with the base rate rising and mortgage rates going from, where we might have been quoting 3.5% comfortably to people, say 6 months ago, 12 months ago. And now we're quoting 5 to 6%. What's interesting is that actually the last 10 years or 12 years, whatever it is, since the global financial crisis of 2008-9, has been the aberration in terms of the base rates. It's not been a normal situation to have a base rate of 0.25% or whatever it might have been. So. And actually, if I just move on to this next slide, and I think that's shown. If you look back in the 80s and the 90s, there were some pretty horrendous base rates there, but property prices continue to go up. I mean, what's your view on that, Emma? What's your sort of view? I know you've got a good story about this.
I bought my first property at 22. I'm not going to tell you how old I am, but but I was between about 9.5%. When I first bought the property. So that was kind of normal when I started investing originally. Obviously, that's tapered off, and it's been an anomaly, to put it for the last 13, 14 years. Since, so that's where we are with rates. So that's quite normal. It does feel like it's a resetting of where we should be.
Yeah, I mean, I think, it's interesting, isn't it? So, I mean, when I first started working in property in 2005 in London, the base rate, as you can see there, was hovering, give or take, around 5%. But people were borrowing at 5.5%. So all that was happening was the bank's margins had been squeezed dramatically, because as I think it said on one of the earlier slides, they still need to lend, and so the more. The more competitive they need to, they need to get more competitive to ensure that people still borrow, and that is the cycle we're moving into, right?
I feel that's the case. Yeah, definitely.
Yeah. I mean, and just to illustrate this point further, what I should say is, by the way, I forgot to say at the beginning, is there is a Q&A button button is a word good enough, I think, on your screen. If you want to ask any questions as we go, please feel free. I'll pick them up and do our best to work through them. With regards to, so what I was going to say here, so if you look at these interest rates, obviously in the 80s and 90s, there were some pretty horrendous sort of base rates. And then obviously it's calmed down, and then we've had the sort of obviously the post GFC period of a very, very low base rate. What's interesting is if you look at average prices in that time, over a 5-year period, they essentially go up every time without fail. And I think this is something that when you're looking at UK property, that everybody needs to remember, right? Because in the end, there are reasons why people buy UK property, and they haven't gone away. All we're facing here is a slightly changed sort of reality.
It's
So
such a solid market as well, Richard, right? We've got history shows that if you hold the asset, and this is, if you hold the asset, you will earn money off of it. There's a supply and demand issue in the UK. It's an island. It's not getting any bigger. So if you hold that asset, we've got enough history to show you that you will earn money on your investment. So,
absolutely.
I'm very much of that mindset. We've all 4 of us have earned money on our properties.
Yeah, absolutely. It's, as ever, it's time in the game. Rather than anything else.
Exactly.
And I think at this point, just to touch a little bit further on that, and to try and answer the question around, is it a sensible thing to do? The reasons, clearly, you just sort of stated them there, Donna. The reasons why people buy property on a very simple basis is because they believe it's going to go up in value over the long term, and they want or they want a source of income, and this is a long-term play. But I think, just to sort of to look at why, again, to really understand, why I, for example, having, since starting work for an agent in London in 2005, we've seen in that last sort of 17 years, we've seen 4 major sort of crises, or whatever you want to call them, whatever the press wants to call them, they always call it a crisis. We've had the GFC, we've had Brexit, we've had COVID, we've now got inflationary pressures pushing cost of living up. And throughout all that period, as we saw in the previous graph, we've seen growth, and which is why, regardless of anything that might happen in the next year or two, if you buy and hold, we will be up in 2 years' time. That's just the way it goes. So, with the UK in particular, it is just worth spending a second, I think, just assessing why this, why that is. And, it's a country of 70 million people with a lack of space and a lack of labour. We cannot build enough product to satisfy demand. So, schoolboy economics that over the long term, that growth is just, it has to happen ultimately. So, I don't think we need to go into too much detail on that. But is there anything from your side to add, Donna or Karen, around it? Because I think the other thing here is regular availability of finance, which has always been the case, right?
I mean, I can speak to personal experience from my portfolio.
Yeah.
The fact that rental demand is definitely there. There's so many inquiries when a property goes on the market for rent. And the turnaround is incredibly quick to get tenants in, depending on the area and the property type. But that's somewhere really where you come in, and we'll be working with you because of the, how careful you are, the due diligence you do on properties that you market, because you do that research to make sure that there is a great tenant demand.
So, for sure. Is it just on the finance, just quickly, has there ever been a period in the sort of your professional careers where an expat or a non-resident hasn't been able to get lending? There's always been providers, as far as I'm, is that right? I know banks come in and out of the market, but there's always been some lending, right?
Yes.
There's all, yeah. Karen, I'll let you touch on that. I'm just thinking.
Yeah, I mean, there's never been a point where expats and foreign nationals couldn't get mortgages. There are plenty of lenders out there that even if one of them drops off the market, there's still loads more. So there's never been a point where you can't get it. I mean, obviously, all lenders have their own criteria about who they accept and who they won't accept. So obviously, if there's a really tricky case, a client who's kind of got a bit of a tricky circumstance, it may be that the lenders may be more slightly limited, but there is always someone there that will be able to help them with the finance.
Yeah, brilliant. We've got a question here from Anonymous, actually. Don't know why it's not showing a name, but thank you very much nevertheless. Question is around interest-only or repayment mortgages. So I think if I can add a question into the question, as it were, first of all, there are still both forms of mortgage available, interest only and repayment, right? That's not changed. No.
No, absolutely, yeah.
Do you guys have an opinion on what's better from an investment property perspective? If you're buying investment property, would you recommend interest only or capital repayment, or what's your view?
That's very client specific, really, what their long-term plans are. If the idea is for cash flow, then obviously interest only will net a higher cash flow. But for example, if they wanted to pass that property on to a child or create some additional equity, and they've got the ability to pay capital as well, then obviously that works best for that client. So it really is very client specific, and that's why we get so involved with our clients, to make sure that whatever we're recommending is in line with what their future plans are and their goals. Yeah,
absolutely. I mean, that's exactly what I would have said too. It's so dependent on what you're trying to achieve. If you want a property to be part of a long-term sort of pension plan and income generator in the future, then you probably want to pay it off, over a 20-year period, and let the tenant do that for you.
Yeah, absolutely. I think it just depends what they want. They've repayment and interest only have both got their pros to them. Obviously, if you wanted to keep your monthly payments less, so you get more of a monthly income, then maybe interest only is the way forward for you. Whereas if you want to own that property completely outright in 10 years' time, you must go for the repayment option, because that is what will then get you towards your end goal. So that's kind of a lot of the time where we come into it and where we can guide the clients. And we then have conversations about, it's not just about what's happening today and what you want to achieve this year. It's about what you want to achieve in 10 years' time and in 25 years' time as well, to make sure that we set them off on the right path to achieve that.
Yeah, perfect.
It's also very important that you talk to the client about budget, right? Because every client is absolutely different. So, I mean, what you do see a lot of, and I've seen it throughout my whole career, and I'm sure that the ladies will agree, is you get so many mortgage advisors that they just stick with the 25 years as their recommendation, rather than drilling down with the client and saying, okay, what's your long-term achieve? What are you looking to achieve long-term? Where is your budget sat? What rental are you getting? Clients might have more income than that, they might want to do it on a repayment and reduce that loan down. And so if it is that they are doing it on repayment, you don't have to go with 25 years. You can talk that through. It could be 22 years. It could be 27 years. Obviously, age may come into it depending on the lender. But it's really about finding out, what is that budget? Really knowing your client and really drilling down onto, what are you looking to achieve? What's affordable? What rentals? And then not just recommending because everybody says so, 25 years. It's about really making the product right for the client. It's so important. So
absolutely.
Yeah,
I think we've actually had a similar question from Hani, actually, so thank you very much for that. So I think we probably answered that for you with that. I mean, something you just touched on there, Donna, and is affordability, right? Which obviously is a basic thing anyone investing should think about. But it's all the more important now with higher interest rates that it is affordable. And from our side, as the sort of the agent dealing with the property side of it, we're very passionate about not overextending people, because quite apart from anything else, we want to help, and we're not helping if we're just all we're trying to do is push the price up. You know, that's not what we're about, and clearly you guys as well.
I think another thing to
I'd like
touch on
to
as
come
well.
in here.
Sorry.
Yeah, I'd like to come in here because one of my biggest frustrations, and you know me, Richard, you've known me for a long time, is I get, well, this person said you can get lending up to 80% loan to value, and this person said, and I'm like, yeah, that's out there. That is out there. But I always like to come in, and so we all do. Anyone that works within the company, we've all got the same ethos. It's always about being cautious, because if a market changes, we're ready for that change. There's no point going to a client, oh, you can get an 80% loan to value. If at point of completion, you can get that, amazing. But what we don't want to do is go out, oh, we can get you this, we can get you that, and shoehorn a client into something.
Yeah, you should never be buying.
If the market changes, it's just so wrong. If
all you've got is 20% and you're buying because there's an 80% mortgage, you shouldn't be buying that product. That's the bottom line. So
absolutely that.
So
sorry, Karen, to cut across you. I didn't mean to cut across you, but I'm just passionate about that point, because I see it every day, and it just
we've actually got quite a few questions coming through. Actually, so if we could just touch on a couple of others. There's a couple of sort of property related questions which we'll get to in a minute. Andrew has asked a question regarding, or sort of with reference to retirement. So, what happens if you retire before your off-plan buy-to-let property is complete and you no longer have income? Can you still get a mortgage based on pension income, proof of savings, lived-in property guarantee, etc., etc.? That's quite a good question, I think.
Yes, is the short answer. Yeah.
Yeah. So, and linked to that, we've had another question asking from Eugenio, asking sort of how to sort of get involved with you guys, and so following this, the answer is that we would make an introduction to, you know, if you have requests, or you know, you have individual sort of situations that you would like Donna and her team to address, to look at. That's, you know, that's the whole point of what they do. And so, with reference, Andrew, for example, to your question there around, you know, retiring, you know, clearly, as Emma's just said, it is possible, but as ever, it's important to have a sort of individual consultation to, you know, to establish that for you specifically, it's possible. You know. What about remortgaging? How easy is it at the moment for a remortgage? Say you've owned property for 10 years, it's gone up in value. You know, how easy is it to pull equity out?
Karen's the best. Karen's been doing so many remortgages lately. It's ridiculous.
I feel like I say the word remortgage about 500 times a day at the moment. But yeah, no, it's easy. It's easy. I mean, it's the same process as if you were buying somewhere, but obviously it's a remortgage rather than a purchase. But there are plenty of lenders out there that will do it. The main struggle that we're having at the moment is the amount of money that we can release for you, especially if you've already got a mortgage on the property, because obviously we have to pay that one off and then you're then left with the remaining. But what we would do is we would work together. We would look at the rental income that you're getting and find the maximum amount that you would be able to release. But that's something that we can go through on a one-to-one basis, because obviously it's different for every single client. But just as kind of a vague answer, yes, it's possible. Yes, it is possible to release money, whether or not you brought it in cash, first of all, and you own that property outright. And you're which
is what Eugenio is saying he's doing. Yeah.
Perfect. Okay. So yeah, I mean, we have lots of clients who buy properties outright, and then a couple of years later they decide they then want to buy another buy-to-let property. So the best way to do that is to remortgage your unencumbered one, release some of that money to then go and use that as a deposit, or possibly the full amount for the new one. So yeah, it's possible, and yeah, it is a really popular way for people to then build their portfolio, because you're then using the equity that you've got in your property to then purchase more properties. And it's a nice, easy way to kind of increase your property portfolio using what you've already got in your name.
Yeah, perfect. Yeah, I suspect I know the answer to this next question, again from our anonymous attendee. I'm sorry I can't give you a name check. When you remortgage, you know, is it a case of going back to your bank who you have a loan with already, or is it always better to shop around?
Depends. Some lenders, you can stay with them and you can do what's called a further advance if they allow that amount. Alternatively, it's always a good option to search the market and see what's available, because it could be at the time when you took your mortgage, that lender was the best one for you. But it could be since then, in those couple of years, it could be that there's more lenders that are out there with better products for you. Yeah. So it's often easier in terms of process to stay with your normal lender, but it's not always the best case. So it's always good to look around.
Yeah, absolutely. I think that's a general truism, isn't it? In whatever it is you're doing or buying.
Exactly. And it could be that we search the market and then we say, oh, actually, do you know what? You're better staying off of them. Just do an increase in them. But at least then you know what's on the market and that you will be going for the right option.
Whatever's going to be cost effective and work for that specific individual client, really.
Yeah, absolutely.
Very good. So at this point, I think we sort of to move us along. I don't want to take more than sort of 40, 45 minutes of everybody's time. So I think just something from my side, to try and answer the question, what strategies to utilize, and partly to sort of answer the question, is it still a thing that can work? There's a number of things I would stress here. Property has always been about, the most successful properties are generally the best located properties in the end, right? So that old property truism of location is absolutely the case. And what I would further argue is that what we sort of call rarity value has never been more important. So if you're going to buy a property and you're going to put your hard-earned cash into something like this, you have to look for locations that have really strong arguments as to why over the longer term they are going to go up in value. I know we've been doing a little bit of work together recently on our most recent site that we launched in Brighton, for example, Brighton and Hove. So for those of you that may not know Brighton, Brighton is, it's the largest city on the south coast. It's a similar size to Manchester, just under 500,000 people. And it has long been it's a well-trodden path for people to move out of London and down to Brighton, down to the south coast, the sunny south coast, as they call it, and it is but it's a town that it's incredibly difficult to find space to build in. There's nothing being built on a basic level. It's all houses. And so from that perspective, if you do come across, an opportunity like that where there's demonstrably very little else that can be built or is being built, that is something, given its popularity as a destination and a location, that will ensure over a longer period of time that the values will rise. And there's lots of different sort of examples of that, but just to use a sort of a topical one. Clearly, with higher interest rates, higher yielding opportunities become of greater interest, which is why probably the prime central London market right now is not what a lot, unless you're looking to park your money for sort of long-term safety. If you're looking for income, you're not looking at prime central London, for example. But what's been quite interesting as well over the last sort of couple of years is that the rents that are being achieved, that are at record levels. So we as a sort of live example of that, we launched a development in the Jewellery Quarter in Birmingham 2 years ago, and we were quoting £800 for a one bed, £825 a month for a one bed. These are now achieving £1,000 a month. And so, yes, the interest rate has gone up, but the rents have sort of gone up commensurately with that. So, yeah, it's just about making sure, my two pennyworth here is just making sure that you are ultimately buying the right thing and making sure that you are careful with what you buy. It's not all been bad news with the recent sort of budgets and economic turmoil with the government. There are some stamp duty savings as well. And of course, the other thing, I mean, I'm sitting here in Dubai, we're dollar pegged with a dirham here but if you're holding dollars or you're in a dollar pegged currency or even, other currencies, the pound has obviously dramatically weakened. So it costs less dollars now than it did a year ago, significantly less dollars to buy property in the UK. So to some degree, almost regardless of, I think, what prices do in the next 12 months, there's an opportunity there, and you're sort of, you're hedging yourself against whatever might happen in the market. So that, anything to add to that, ladies?
I would say because one of the things that's become very apparent is the type of lenders that are available, and what we've seen is that we're getting more those, what you've just alluded to, the short-term let, the holiday lets, the student lets, the HMOs. We're seeing more lenders coming into that space, whether you're buying it in a personal name or a limited company name. There's more lenders coming into that space. We did some work together on the Goldstone apartments for your Brighton project, and we saw a lot more lenders that were offering that holiday let type of lending.
Yeah.
So that's key. Also, it's important to understand that the banks that sit in the international space, there is such opportunities there. We've probably seen 3 new banks come into the space within the last few months, and we've been exclusive with 2 of those. So they're recognising that, the international investor, that business is there, and these lenders do want to lend. So it's important that you people realise that there are exclusive lenders for this kind of market. So it is a good market to be in, and especially if you're an overseas investor.
I was about to say that the international market has been unbelievably busy. Obviously, clearly we're not representative of the whole market, but as RPA, there were more transactions in October than any other month in the year, despite the uncertainty.
Best month.
So it just shows that. Yeah. So just I've got another question here from Eugenia around the stamp duty cuts. So the way that works, and I'm afraid I don't have a slide for this, but we can communicate perhaps afterwards. But there is essentially a saving for everybody, regardless of whether you're overseas or domestic. Effectively the underlying stamp duty is now 0 to I think it's £425,000 off the top of my head. And so from that perspective, it doesn't make such an impact for you as an overseas investor as it would for someone based in the UK, because you have the 2% non-resident stamp duty. If you own another property, there's the 3%, but it will save you around £2,500 from what it was, just over a month ago. We've also had a question from Manish around locations and cities of interest, and particularly London versus other locations. I think, again, Manish, without trying to dodge the question, so much of it is dependent on what you're trying to achieve. If you're looking for income, then London is possibly not the answer. If you're looking for sort of long-term stability, then London can still work. It's also worth noting, actually, that with the increase in the record levels of rents that are being achieved in places like London, actually the yields have increased from what they were. We're working on a couple of developments in sort of zones 2, one in zone 2, one in zone 5, and actually the yields are 4% plus, which for London is pretty good. Whereas if you go out to Brighton, for example, a yield would be more like 6%. You go to Birmingham, it'll be more like 6%. So a lot of this is the answer to that question is essentially, what are you trying to achieve? And that's the role that we at RPA play, is to try and advise you and give you some ideas around and sort of help you answer that question. What are you trying to achieve? therefore potentially this works, or therefore potentially that works. It's probably good at this point just to explain. I don't mind who wants to answer this question, but how do you help? What does the process look like? Emma.
Well, Richard, you know how we work, and that's why we work together. So it starts before, when we work with new developments, it starts before it even gets launched. So checking that the development can actually get finance for the individual that's the end purchaser. So what we'll do is we'll take that information on that project and we'll send those to the new build lenders in the space that is being distributed to. So, for example, all of our new build lenders that deal with international purchasers, we'll send that project out to them and they'll give us the green light to say, yeah, we're happy to lend on that project. So when the buyers come along to you guys, they already know that that's been checked out by a bank. That is so important.
Yeah.
And you and I, Richard, have seen the outcomes when, through different various people that we've spoken to along our years, that people that haven't done that, and we've kind of gone, okay. So It's so important that is done right from the off. Speaking to the mortgage advisors with all the changes that both the ladies have alluded to there, it's so important that you do speak to a mortgage consultant. The stress testing on the rentals that are achieved, they've just changed over the last few months. So it's important that you understand how that's then the rental that's coming in, what you can actually borrow based on your circumstances. One of the other things that I think gets really missed is how you package a case. It's not about ticking a box. We've got 3 months bank statements, we've got 3 months pay slips. It's about presenting that client to the bank in a way that you're not just another client. It's about making sure that when you're packaging the underwriter that then receives it, build that story. What's that client trying to achieve? What are they? Who is that client? You're not just a black and white piece of paper. You're a person. Let's build the story of what you're trying to achieve. Especially in the Middle East, if you've got Mr. and Mrs. and Mrs. hasn't got an income, but Mr. might give her some income. Build that story. Understand what goes on with that investor and what goes on with that family and what they're looking to do. So we do that in the way that we package our cases. And we're always, the guys will tell you, we're always on the phone with the lenders saying, what can we do better? What can we do better? Because we're trying to evolve and to make sure that when they get a case from us, they go, it's one of their cases. We don't mind looking at it. So about building that story and making sure that case is packaged properly is so important.
It's an industry, isn't it, where there is sometimes a computer says no element to it, and so to get around that's what you're talking about. I think also just to add in terms of how RPA can help. So the idea behind what we do is obviously with working with partners such as Donna and her team and IPFG, the idea is that we can provide a very consultative service. What we're not looking to do is just flog a development. It's trying to understand what you as a buyer are looking to achieve and trying to find the best solution for that. We are a completely independent agent. So in theory, we obviously have access to the entire market, but what we're trying to do is provide access to products that are ultimately, as Don has just been talking about there, thoroughly researched and thoroughly sort of put together, so that we know, we can look you in the eye and say, this is something that will work for you, and have a range of those products. Just worth mentioning as well that, obviously the mortgage part of it is incredibly important, but so is also the lettings and management. And so we work with, or our sister company, Brick Management, who provide that service for all of our buyers who purchase a property through us, and some who don't purchase the property through us but have other products that they want to other assets they want to let out, and that again is designed to be a personal service that, in the end, as much as possible, removes the hassle. So, should anybody want a conversation with Phil and his team at Brick, that of course is something that we can arrange as well. I've had another question from, how are we doing for time? 5:47. Another 3 or 4 minutes. I had another question from Bunmi. What level of leverage is safe? This is a great question. So how much should you borrow? And while some of it is the old caveat, how it depends slightly on your situation and what you're trying to achieve, as a general rule, Donna, what, or whoever is best qualified to answer this question, what sort of percentage of what LTV, loan to value, are we looking at as sort of best advice on a sort of as a general?
I'm going to hand that to Emma.
More qualified to answer that one. Yeah, I would anticipate. Again, it's very, very individual on what a client's looking to achieve, but anticipating providing maybe about a 35% deposit is probably a good margin. Everyone's risk appetite is different, so someone might want to leverage a little bit more, someone a little bit less. But yeah, aiming for about 35% deposit is probably in the ballpark of where it's nice and comfortable to sit. Yeah,
no, very good. I know, certainly that's because the other part of this is that, as you alluded to earlier, Donna, there might be 80% mortgages or certainly advertised mortgages, but no one should be buying a property that they can't afford to put at least 35% plus costs into. If you're stretching yourself, that's the fastest route to actually putting yourself in a difficult position if the market changes. And certainly we at RPA are very keen to make sure that doesn't happen, because we're trying to build long-term relationships with our buyers and help them build portfolios. And the fastest way to ruin that is to oversell something. So,
and I think as well, a lot of lenders will say, "Oh, we can give you 75%," but you don't have to take all that. Even though they can lend it to you, you don't have to. And I think you have to stick with what's comfortable for yourself, your situation right now, and also if you can foresee any changes in your situation as well, you need to kind of account for that as well. So just make sure that you're sitting comfortably, and like Emma said, around kind of the 30-35% is kind of quite comfortable.
I think also this so just to add to it from a sort of strategy point of view, there is, because of the weakness of the pound at the moment, if you are sitting in dollars or dirhams or whatever it might be that is dollar sort of pegged or dollar linked, there's an opportunity to actually put more equity anyway, put more in anyway to start with. So I think that's something that, again, to mitigate against maybe a higher interest rate than you were planning, that's something to look at. Also, the other we've just had a question around off plan versus complete assets. I actually think, it's always a very personal thing, and this is where sort of we would like to sit down with people and help them establish whether it's the right thing for them. But there's often been a push for buyers to buy completed property because it's there and it's less risk, and that is all very valid. But there is actually potentially an argument at the moment for a longer build off plan property, because you'll probably end up with a better interest rate in 2024 than might be available today. So a lot of the product that we offer, a lot of the stuff that we're involved in, we get involved with it right at the start. And so from that perspective, actually to put down 20% or whatever it might be, 15% down now, and to then wait for 18 months, 24 months for that sort of asset to be built and come to fruition, I think there's a reasonable argument for that now, as long as you manage your risk profile.
I agree.
I think what we might do now is wrap up, just because we are 51 minutes into it, and we've got some very patient people listening to us. So thank you very much to everybody for that. there is one question that does always come up, particularly for overseas buyers, is UK bank accounts. Is that something that you can help with, solutions, for people that don't have, and are they necessary?
Most UK lenders will need to have a UK bank account. Some lenders don't require it, but the majority of them do. We can't actually physically open the bank account for clients, but we can guide you. We obviously know some lenders that will open bank accounts. There's some online bank accounts you can open. So depending on your situation and what country you're in, we can definitely guide you with that.
Yeah, absolutely.
There are a couple of banks that will automatically onboard and open a bank account for the client as well as part of the mortgage application. So that kind of covers that base as well, if that's necessary.
Yeah, fantastic. So with what I would just say, just to sort of to wrap up, what we haven't really talked about proper like individual products or anything like that today. That was obviously not the point of today's session. We do have a wide sort of a range of as RPA products and property that we're working with at various different stages of build, various different locations, different yield profiles, some of which might be short-term lets where you can achieve 10, 12% yield. Some of it might be, more standard long-term lets, different and obviously different locations. So what I would urge everybody to do, if you are interested to discuss further, to talk in more detail about the market, is please do reach out to us. We can share a copy of this presentation as well, but we have oodles of information of different guides of whether it be London or Birmingham. We have lots of hopefully interesting reading material, and obviously we would love to have a conversation with people one-on-one and see if we can help. But I think for now that's it. So Donna, Emma, Karen, thank you so much for joining us today.
Thank you, Richard.
And obviously, should anybody want to talk to you guys, we will put them in touch.
Thank you very much. Thanks everyone for your time. Really appreciate it. Thanks for inviting us, Richard. We love working with you guys because we know that we work side by side, and I just love that. And we've known each other for a very long time. So thanks very much.
Amazing amount of time. Yeah, absolutely. All right. Thanks everybody. Thank you very much.
Lovely. Thanks, Richard. Thanks everyone.